Let's talk about down payment. So in many videos before, we said that there are three things that you need in order to buy a home. The first thing that you need is income. Second thing is credit. And the last thing that you need is down payment. Many people ask me, what is the most efficient amount, the most efficient percentage that you use or that you would use to put as down payment? Will you put 3% down, 5% down, 20% down, 50% down? Some people have the cash. So my answer, it's always different because I really need to know the specific case. So what I tell them is like, well, if you don't have money, like if you are counting pennies in order to make it happen, well, I guess 3.5% you are gonna do an FHA loan. That's the minimum down payment that you will require. Okay, the other option is to use a conventional loan, which is 5% down, 5% of the sales price, right? Well, 5% is not a bad deal because you save a lot of the headaches of the FHA loans. The FHA loans are a little problematic. You need to pay fees up front. And the other thing is that they require that the property is in really good shape under their guidelines. So they want that there's no chip on paint, that the roof is perfect, and things like that, you know? So 3.5% for FHA loan, 5% for conventional, okay? And then I personally always when I buy, try to use 20% down. Because when you use 20% down with down payment, you save in the PMI. The PMI is the mortgage insurance. That's money that pays an insurance that protects the bank in case you default. That doesn't help you at all. That helps the lender, which is kind of crazy, you know? But in any case, 20% down and you're gonna save $150, $300, whatever is the additional monthly payment that you need to pay because of the mortgage insurance to protect the lender, you know? So that's on one end. So you need to determine, you know, your capabilities. I mean, how much money you have in savings, how much money you have in reserves. 20% is probably, in that matter, an efficient point because you're gonna save on that, right? And also your payment is gonna be a little smaller. Now, let's talk about interest rates. That's the other criteria that I look. If the interest rate is close to par with the real inflation, like right now, whatever BS the Fed tells you that the United States have, you know, they tell you 2%, 3%, but in reality, the real inflation is the compound of all the assets in the economy, including food and rentals and housing, right? So the real inflation should be around 5% in the United States, okay? So if you can borrow money cheaper than 5%, I would say go for it. If the money that you can borrow is around 6%, I'm still on board, you know? Anything over that, and if you have the cash, you can put more money towards down payment, let's say 35% down, 50% down. But if you are within, you know, if the interest rates are up to 5%, 6%, I would tell you, my suggestion is like you should be buying more properties that give you a better cap rate. So let's say that you put only 20% down for your primary residence, and then you buy a 2-flat, 3-flat to rent it out. And then the cap rate, so the return over your investment on that new property, let's say is about 12%, 15%. I mean, why wouldn't you do that? You're making 12%, 15%, and you're paying the bank, whatever, 5%. So that spread is your profit. So that's the debt, that's the leverage that I like. You know, when you borrow money from the bank, you use it, you pay the bank, and then you keep a profit. That's the best type, you know, that's my type of vodka. So that would be the second criteria. But in any case, what you need to do is always call me. You know, we can talk about something customized for your specific situation. My name is Germán Llanos. I'm the managing broker of 24-Hour Real Estate, and I have offices in Chicago, Illinois, and in Dallas, Texas, and I'm looking forward to talk to you.